And Rahul, thanks so much for joining us bright and early this morning. First of all, help us understand the impact of quarter four earnings that we've seen. We've already seen two of the biggest private sector banks reporting above estimate numbers. NIMs have expanded. What's your overall outlook for the sector in terms of quarter four? Because the beginning has been rather good for this sector.
Thank you, and good to be on your show. So just to take a step back before I get into your question specifically, we actually has revised our view on the Indian banking sector. We were actually a bit cautious till a majority part of the last 1.5 years. But as we start to look out into this financial year, we feel that the sector actually will start having better visibility on its profitability over the next couple of quarters. This will be on the back of two important variables. One is the credit cost. So for the last 2 years, we've been quite cautious on the unsecured lending across different segments. We clearly see that starting to peak in terms of the a pain point for the banking sector, and that will mean that over the next 1 or 2 quarters, the credit cost will start to peak out for the sector. And also on the margins front, given that the Reserve Bank of India started cutting the repo rate, we feel that most of the impact on the margin should be reflected in by the second quarter. So by second quarter, we expect the EPS cuts to start bottoming out, and there getting to your point about the start of the earnings season has been rather good. The lenders have managed to maintain their profitability, and we've already seen the cut in savings rate, etc., which will also support the profitability. The impact of the NIMs would be well absorbed from the policy rates. So therefore, we feel that this is the scenario of light at the end of the tunnel for the sector. From being in a muddle through for a good part of the last 1.5 years, the profitability will start improving. But the only element which we are watching out for is the credit growth. Given that the GDP growth has been sluggish, we do expect a delayed pickup in credit growth. We expect the growth to be in the range of 10 to 12% for the sector, and then we'll see how it plays out depending on the GDP growth. Yeah.
Okay, and while you spoke about the RBI and rate cuts of how they have provided a fillip to the sector, RBI has recently also published the LCR norms, which was yet another positive for the banking space overall. Now, in a nutshell, tell us how it will impact the NIMs and return on assets as rate cuts possess some downward pressure on NIMs. Do you think such actions will offset the downside partially?
So that's correct. So if you look at the theme over the last couple of months, the regulators have been rather supportive to the sector. They've taken multiple measures to infuse or improve the liquidity scenario for the financial sector. And the guidelines on the LCR is perhaps along the similar lines. Of course, the draft guidelines had caused a concern amongst the lenders about preserving their LCR because of the runoff factor. But clearly, the guidelines that came out went on to reinforce the view that the regulators are willing to support the liquidity measures in the sector. And, clearly this is going to help the lenders to better manage their cost of funds and also, therefore, result in better management of the margins. This goes back to the point that, I was making earlier. I think the lenders have been quite cognizant of the fact that the NIMs will have to be managed, and every incremental support that is coming from the RBI is going to help the lenders manage their profitability over the next couple of quarters.
Okay, so thanks for that view coming in. Also, Rahul, want to understand your outlook on the entire microfinance space, because we understand that we have been seeing some pressure on asset quality when it comes to the MFI segment, and this is across financials. Some market participants are expecting quarter four to be the peak of MFI stress. Do you agree with that view, and where do you think asset quality is heading? Do you see it improving anytime soon?
I think we would agree with that. I think the earnings that have come out so far and the commentary that we have seen or the business updates that have come out clearly seems to indicate that the pain in the MFI space is fully reflected into the earnings estimates of the street. And I think clearly, you will see better trends going forward. But I would also like to caution that first half is typically a weaker period for the MFI space because of lack of business activity and perhaps some more NPL formation. So therefore, we'll have to see how the second half of the financial year plays out. the government had put out for the public comments. How that gets implemented and what impact it could have on these segments will also have to be watched out for in the second half. But I think whatever pain point the sector had witnessed because of the change of the lender norms or the Karnataka ordinance impact has been by and large factored into the numbers and have been absorbed by the industry, and incremental trends have been actually pointing towards a better direction.
All right. Hi, Rahul. Good morning. This is Shrishti also joining in. But Rahul, last year we also saw the PSU banks gaining share in the loans from the private sector banks. Now, PSUs also reported a healthy asset quality trends. But do you think that the PSUs will contribute to the gain that the loan book market share in FY26 as well? What's your outlook there?
So the way we would see it is clearly the market share has been continuously being gained by the private banks in the deposit market share. And on the lending side, both the private banks and the NBFCs have been doing a decent job. And that actually has led to some bit of a pricing pressure in select pockets such as mortgages or the larger corporate loans. But I think from the investor standpoint, they clearly seem to prefer the entities that can produce predictable earnings quality and stable profitability profiles. So clearly, I think the private banks and NBFCs are being preferred by the investors that we are speaking to at this point of time.
Okay, so that's the outlook on the entire PSU space. And Rahul, before we let you go, just one last question. Now, with the overall rate cut expectation of roughly 100 bits, there will be some pressure on the NIMs in the near term as well. On the other hand, you have regulatory actions that are giving a positive thrust to the entire system. In this tug of war for NIMs and ROAs, what's your overall outlook? Who do you think is going to emerge winner? What are some names that you're liking right now? And do you think at these valuations, some bank looks attractive to buy?
I think completely agreed with you. I think the outlook has improved. Like I was saying earlier, I think we will have the repo cut related impact on the margins. But on the other hand, the regulators have also been supportive to the sector by infusing liquidity. The wholesale money market rates have dropped, which will also support the lenders. And then thereafter, we are also starting to see the cuts coming through in the deposit rates. We have seen the savings rate being cut by pretty much all the important lenders, the large lenders in the private space. The term deposit rates have been cut. So the lenders are trying very hard to manage the margins. So of course, you'll see an impact. The margins will trend lower before they start to stabilize. So it'll be a first half phenomena. Second half onwards, we expect the trends to start to stabilize, which is why we feel that there is a light at the end of the tunnel. The ROA start to stabilize from 2Q onwards for the sector. And that actually is something that the investors seem to be liking. And that's the reason why the sector is rallying at this point of time. But like I said, the credit growth is something that needs to be watched out for. And there we are expecting some improvement in the second half, driven by the variety of policy measures that both the government of India has taken in the form of tax cuts, leaving more money in the hands of the households. Plus the interest rate cut will also improve the disposable income. So all of that actually should start to come to the support of the credit environment in the second half. And then we'll see how this plays out into the next year. But yes, the credit growth will be more like 10 to 12% and not substantially higher than that.
All right, Rahul, we let you go on that note. Really appreciate you taking the time out and speaking with us and helping us with the outlook, what lies ahead for the banking space.